The way I like to think about it is, for simplicity's sake, I would take your average cost of labor for a tradesman, and then I would separate out site managers and project managers and the more expensive ones. I would not have a separate lower cost of labor for apprentices. I would have a cost of labor and allow yourself to consider that apprentices are lower cost labor for you, but not lower charged labor. All right. What's your charge out rate? Do you have a charge out rate? I mean, you do somewhere, right? Even if you charge per point or anything like that, somewhere in there is a labor charge out rate. Do you have that? Do you have one? And do you know what it is? And what's the margin between your cost of labor and your charge out rate? Do you know that? And what's the gross margin you believe you make when you do a quote? So what's the gross margin showing in your P&L report? This is the cycle I go around when I want to check in on your money with you, isn't it? How's your gross margin going? What is it showing up in your P&L? Because if you think that you're getting 30 in your jobs and your P&L is showing 7, then there's a problem, right? So my next question is, what's the gap? What's the gap in dollars every month or every year? And what's the gap in percent of revenue? What's your charge out rate if you have one? What do you believe the gross margins are when you do a quote? How confident are you in that? Right. So I'm going to call that your notional gross margin, right? The one you think you get when you put an estimate together, you probably got in your mind an understanding or an idea of what you think it is, right? But then if you then go, all right, I think it's whatever that number is, it could be 20, could be 30, could be 40% of your revenue. If we go and look in the profit and loss report, what does that show? And is there a gap? And if there is a gap, you've got a problem. If there isn't a gap, right, you pat yourself on the back and you go, I don't need to listen to the rest of this. I've got it all going on. Let's see if anybody does that. Right. This is the main killer thing for a trade business, right? You're not a high margin business like some of them. Margins are really important, and your not massive margins are easily eaten up by all that list of 11 things I was just talking about. So this is crucial stuff. I constantly come into contact with people who are busy but don't make much money. And it's because of those 11 things. And it's because they don't go around this cycle enough and fix the holes. So what's the gap? Have you all got a gap between what you think the margins are when you quote and what they show up as in your profit and loss report? What I want you to do, of course, is understand what your gap is and how bad of a problem it is. Right. And for a lot of people, what I see is that what you do is you get given or somehow receive a list of rates, perhaps from a previous employer or something like that, when you had a job, and you use them. My next question is, what's the link between quoting and execution of jobs? And I think for a lot of you, it's broken. You price the job using your estimating process, and if you win it, you do the job. But the link between how it was priced and how it's done might not be there. Right. So I think for a lot of people, that's a case, right? The way you price maybe isn't granular enough and can't recognize things like we had to do a second story and put scaffolding in. So I want you to think about that. Is that a thing? We've gone around the virtuous cycle. We're hoping to find where it's broken for you. So I want to focus today on measuring job profitability, because if you can measure it, you can see what's wrong and see what you can change, right? So it's giving you guidance. So what do I mean by measure job profitability? I think when you do a quote, you have an idea of your margins and of your inputs, labor, materials, hire equipment, subcontractors, rubbish removal. Is there anything else I've missed that's kind of an obvious thing? Warranty insurance if you're a builder, maybe, right? And then your inputs, your costs, plus your margin gives you your sale price, which is your quote. You could call this, if you want, your predicted costs of doing the job, and then your margin, and then your invoiced amount or your quoted amount. And once you've done a job, you've got your actual costs of doing the job. The same inputs, right? How much actual labor got used and paid for, how much actual materials got bought, what actual invoices you got from subcontractors, what hire equipment you ended up using, and what you ended up paying for rubbish removal. I will note you quoted for a scope of work, and during the job, that often changes. If you track your variations properly and you charge for them, the percentage of gross margin should stay the same, but the dollar value of it might change. And of course, I'm working on people who are doing fixed price quoting. And if you're not doing fixed price quoting, you should be. You all know how I feel about that. So we're interested in what was in the quote, and then what happened when you did the job, and how they're different or whether they're the same. Okay. So we're staying away from doing your quote right in the first place. We're going from understanding how it changed from when you did a quote to when you finished the job. If the margin increases, dollar value and percentage could both increase, right? And then we're also interested in the different stages of a job. If you did your quote in stages, Some of you do your quotes in stages, don't you? And you list them in different stages so you can break them up like that. That's probably the best way to try and measure the job profitability by how they are in the stages, in the quote rather. So we're going to try and compare inputs and actuals, or predicted costs and actual costs, for the various stages of your job. So what do you need? You need your quote, obviously, and you need your project plan if you've got one, which I know for a lot of you is very related to your quote. And some of you have a written project plan and some of you don't. And some of you, I would say, all of you have a project plan in your head, even if you don't write it down. You all kind of know what the approach is going to be and what should be happening first, right? So you have your inputs, your labor and your materials that went into your quote, and your labor and materials that come out of the end of the job. You need a way to compare them, and you need an output. So you need the quote and the project plan, the inputs, the labor hours and where they went, which part of the job, the materials, hire equipment, subcontractors, rubbish removal, as they compare to the bits in the estimate. You need a way to compare them. I'm going to suggest a spreadsheet with 2 bits, 2 columns, side by side, so you can see them. And you need an output, a report maybe that you can trust, which comes either from a job management system or someone compiles it manually. I also want you to have the output for a job, but then also for multiple jobs. If you do it for one job, you can say, this job went well, or this job went wrong here. And if you do it for multiple jobs, you can see that, we always do this thing wrong, or this always happens for us. And you can then make allowances for that somewhere around your virtuous cycle. You also need to be able to interpret what you've learned and make changes to the things in your virtuous cycle, or those 11 places where money disappears, so you can stop losing money and keep it in the business. Hooray.